Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is June 2nd, 2013 edition of Market Outlook. Please be sure to sign up and get this for free every week just by going to our website, www.marketgauge.com, and also there you'll find places to sign up for our premium services, which will give you a real-time view of the markets and specific recommendations. So without further ado, let's get into the markets here. Lots of interesting things occurring all across the board. First thing is the spiders. Well, as you know, we called this week's edition of Market Outlook Look Out, and there is a reason for it. So the first thing, let's go from the highest level. On the monthly charts, you can see that we basically took out a multi-year or historic highs recently and really ran up. But we had some very interesting action on the daily charts, which we'll get to in a moment. But please note that we are still in extremely overbought territory on a monthly basis. So yes, we closed up quite strongly still for the month, but the shorter term pattern is ominous. Let's take a look at that. Well, first of all, at the next level, the weekly charts, you can see that we have this fanning action, and interestingly enough, I had put this in a market outlook from several weeks ago. We actually touched the exact top of this trend line here, right? This is what we call fanning action off the lows, and this particular trend line in here, basically you had a return move exactly right up to this trend line, as well as reaching overbought levels on the relative strength index. Now, taking it down to a more granular level, you can see that we had this was about 7 trading days ago. You had a key reversal pattern, which we've been talking about, where the market gapped up, ran to new historic highs for this index, for most of the key indices, and closed on the lows. Now, since then, a couple things have happened. Number one, the action after that particular reversal pattern, we call that a glass ceiling. You also had a pattern where it opened up and then ended up closing on the highs and had a rally. So by sort of bracketing, let's take a look at bracketing this area, the high and then the subsequent low of that pattern, this was sort of the trading range, and inside of that we were sort of neutral. Now since then, the 10-day moving average has sloped down, and Friday's action with the 100-point drop in the dramatic last few minutes of the day made this index close beneath the lows of that rectangle. So the indications are that we are in for a correction for sure. Now, of course, this would get negated if we ever took out the highs of this pattern, which are a good 5 points away in the SPY. So logical points to find support are at the 50-day moving average, which is right around 160, and also around that gap. So the other thing to note is take a look at the patterns down here. You have increased volume on the downside. The few days that we had rallies since this top in here was put in, that key reversal day, you've had very weak rallies on light volume. This is showing that there's some serious institutional selling. So that is another factor to consider. Okay, next, let's take a look at some of the indicators. Interestingly enough, as we were making new highs, right, our McClellan oscillator, which is more of an intermediate term basis, peaked out well before the market actually made new highs. And so this is highly unusual action, that we've actually are at a bit oversold levels while the market is just starting to go into a correction based on the McClellan, which is more intermediate term on basis. However, interestingly enough, the shorter term indicators, both advanced decline and up-down ratio, confirmed a sell signal on the key reversal day or the day after. So that pattern is still in effect. The advanced declines, you can see, are already extremely weak, and this is barely gotten underway in terms of price movement to the downside. So this, along with that Titanic indicator, or the Hindenburg indicator, where we've gotten more new lows recently than new highs, as the market recently just made an all-time high, is very, very ominous. Okay, now, what contributed to this is the TLTs, or the 20-year bonds. So this is quite interesting here as well. As you can see, we've been talking about a potential top forming in the very, very long-term trend. The secular trend in bonds has been really down since the early 80s, and now that extremely low rates have sort of peaked the prices in bonds. You can see here's the 65-week moving average. We've now traded under it on the daily charts. Let's take a look here. You can see we have this declining 200-day moving average, which really has been something new that has occurred over the last couple months. We attacked this declining average, but you can see this is sort of like the force of gravity. We had a couple days where we closed over it, or even a week or so, but downside with a vengeance. Now, we are at some support levels. You can see a significant bounce off the lows from Friday as the market crashed. Not surprising, flight into the safety of U.S. Treasuries while the market is under pressure. So overall, this this unfolding new paradigm shift, which is, higher interest rates, is certainly having an impact on the market, and that action on Friday, not surprising that it finally gave way with bonds actually making new highs in actual rates, but a little bit of a rescue here. But overall, looking like the trend, unless of course we get some sort of crash or something like that, which is not out of the cards. Certainly a lot of people are expecting, either a serious correction here with the advent of higher rates, and no one is really sure what the Fed is going to do. But nonetheless, this trend is certainly unfolding here. Rates look like they're going to be heading higher over the next cycle, or the next secular trend. Okay, let's take a look at volatility. I'm switching here to the VXX. Interestingly enough, you can see that the daily chart, the Bollinger Band's still trading inside the Bollinger Band, still trading under the 50-day moving average. So one thing that is sort of contradictory to everything we've been looking at here is the fact that the VIX, yes, it did move up, but it's still on an absolute basis under that 50-day moving average, well under the 200. Let's keep an eye on that, because if we get over this 1950 level, you're going to see potential some spikes here, which would confirm a further move down in equities. So this is an interesting key. This is going counter. So this is actually more positive for the market, that the level of panic here, or the level of concern, is not quite showing up in the VIX. Let's take a look at gold. Gold, very, very interesting. You can see we've put in potential bottom here, a double bottom formation. All those Friday's action with gold on selling off on the close and breaking this short trend line is definitely a sign of some weakness. So overall, long-term trend is still very much down. Potential double bottom. On the other hand, if there is really a big drop in equities, you can certainly see liquidation of many asset classes all at the same time. But the way to play this, clearly, if we start getting under this trend line on Monday, I would be looking for a break of this particular pattern here. However, there is one mitigating circumstance, and that is GDX. So taking a look at GDX, which is the gold miners, they're acting quite a bit differently. If you look at it, the gold mining stocks, the underlying physical metal, has basically also exhibited a double bottom, but with yesterday's action, Friday's action, which was an inside day, you could actually see a potential bottom forming here, which is quite interesting. So with that, that would indicate, right, if the gold miners are bottoming here, that would indicate that potentially the actual gold bullion, GLD, or the futures are potentially also bottoming at the same time, or at least ready for some sideways action. So overall, the evidence here, if we can hold this inside day and break out, would be that gold has temporarily bottomed, although the longer term trend is still in effect and down. Looking at things from a slightly different perspective, this is some new charts we've been working with. This is looking at the gold miners versus the gold bullion. And you can see here, these are the actual ratios. So this is a ratio with a moving average on it. So you can see that bullion for since 2011 the GLD has well outperformed the gold miners. However, on a shorter term basis, take a look at this. Very interesting pattern here. As you can see, this is the moving average on a daily basis, much shorter term. So with this moving average here, you can see that the gold miners are starting to outperform and have actually taken out this quite a bit of sideways action, as well as the moving average, and it's turning down. So there may be a period here where gold miners are going to recover from its downtrend relative to GLD. And that's sort of showing up in the short-term pattern. Okay, well, that's, I think, a pretty good synopsis. Stay frosty because the markets are definitely in play. Things are shifting, right? Between interest rates, the gold and gold miners, the volatility, and the overall short-term pattern in the market with some very interesting market internals, this is definitely at an unusual and critical point. So have a great weekend. Look forward to seeing you next week. And don't forget, sign up for this on our website for free. And if you want to see how we're playing these things in a very specific way, there are a bunch of services. If you're more of a swing to mini swing type trader, sign up for Mish's Market Minute Premium. And if you're interested in day trading, we have a fabulous day trading room that'll take advantage of these short-term moves. So bye for now, and see you next week.